Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Associated Banc-Corp annual report. Associated Banc-Corp offers a wide range of banking and non-banking products and services to individuals and businesses across several states. The company's lending solutions include commercial loans, lines of credit, construction loans, leasing, asset-based lending, equipment finance, loan syndications, residential mortgages, home equity loans, personal and installment loans, auto finance, and business loans. In addition to lending, the company provides deposit and cash management solutions such as commercial checking accounts, interest-bearing deposits, cash vault services, liquidity solutions, payables and receivables solutions, and information services. Associated Banc-Corp also offers specialized financial services, including interest rate risk management and foreign exchange solutions. The company's fiduciary services include administration of pension plans, profit-sharing plans, and other employee benefit plans, as well as corporate agency services and institutional asset management services. Furthermore, the company provides investable fund solutions such as savings accounts, money market deposit accounts, IRA accounts, CDS, fixed and variable annuities, full-service investment brokerage, and online investment brokerage. Associated Banc-Corp also offers various transactional solutions including checking accounts, credit and debit cards, online banking, bill pay, and money transfer services. The company operates loan production offices in several states across the country, providing its services to a wide range of customers. Associated Banc-Corp's stock price has seen a significant increase of 14.03% over the past year due to a series of positive financial results and strategic corporate actions. The company's consistent growth and profitability have been key drivers of this upward trend. One major factor contributing to the stock's rise was Associated Banc-Corp's strong earnings reports throughout 2025. In its first quarter, the company reported net income available to common equity of $99 million, surpassing analyst expectations. This momentum continued with record-breaking second and third quarters, where the company exceeded expectations in terms of net interest income and loan growth. The acquisition of American National Corporation in December 2025 was another significant event that propelled Associated Banc-Corp's stock price upward. Valued at approximately $604 million, this strategic move aimed to accelerate the company's growth and strengthen its presence in key markets. Furthermore, the company's better-than-expected fourth-quarter earnings and full-year results in January 2026 solidified its position as a strong performer in the industry. The declaration of dividends and share repurchase program also signaled the company's commitment to returning value to shareholders. Overall, Associated Banc-Corp's consistent positive financial outcomes and strategic initiatives have contributed to the stock price increase over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be attributed to several key factors. Net interest income and non-interest income are significant contributors to revenue growth, as they represent the core earnings of the business. Additionally, capital markets revenue, mortgage banking revenue, asset gains, investment securities gains, wealth management fees, service charges, and deposit account fees all play important roles in driving revenue upwards. On the other hand, revenue decline can be attributed to specific events or actions taken by the company. Non-recurring losses incurred due to investment portfolio and mortgage sale actions, as well as sales of lower-yielding securities resulting in a net loss, have contributed to revenue decline. Furthermore, the reinvestment of proceeds into higher-yielding securities has also had an impact on revenue. Interestingly, some areas of the business remain relatively stable despite changes in market conditions. Indirect auto revenue and other consumer revenue are influenced by general economic conditions, borrower characteristics, and loan collateral, but have shown resilience in the face of fluctuating markets. The net income of a company underwent significant fluctuations between 2023 and 2025. Initially, it decreased by 74% from $182,956,000 in 2023 to $123,145,000 in 2024. However, this trend reversed in the following year, with an impressive increase of 286% to reach $474,777,000 in 2025. The change in profit margins across different segments also warrants attention. In the corporate and commercial specialty segment, profit margins decreased from 49.3% in 2023 to 46.2% in 2025. Conversely, the community, consumer, and business segment saw an increase in profit margins from 35.5% in 2023 to 34.1% in 2025. The risk management and shared services segment experienced a decline in profit margins, dropping from -99.9% in 2023 to -106.2% in 2025. The reasons behind these changes are not explicitly stated in the provided summary. However, it is clear that the company's financial performance underwent significant fluctuations between 2023 and 2025, with some segments experiencing improvements while others faced declines. The company's financial performance indicates a positive trend in its ability to generate operating cash flow. The data shows that the net cash provided by operating activities has been increasing over the past 3 years. In 2023, the company generated $442.7 million in net cash from operating activities. This figure increased to $580.2 million in 2024, representing a growth of approximately 31%. Furthermore, in 2025, the company's operating cash flow reached an impressive $615.7 million, marking a significant increase of over 6% compared to the previous year. This upward trend suggests that the company is effectively managing its operations and generating sufficient cash to meet its financial obligations. The positive operating cash flow indicates a strong foundation for future growth and stability. The company's debt level and interest expenses have undergone significant changes in recent years. On one hand, the total debt has increased significantly from $2.7 billion to $4.3 billion, a 56% increase. This is evident in the corporate and commercial specialty segment, which saw an increase of $3.9 billion, while the community, consumer, and business segment experienced a growth of $0.4 billion. However, on the other hand, there has been a decrease in interest expenses, with a reduction of $103 million from 2023 to 2024, and another $103 million decrease from 2024 to 2025. Despite the increase in debt level, the company's interest expense has actually decreased. This is attributed to the reduced target range for the federal funds rate, which has led to lower interest expenses. In fact, interest expenses have decreased by $45.8 million from 2024 to 2025. Furthermore, the total debt has also decreased slightly from $5.47 billion in 2024 to $5.59 billion in 2025, indicating a slight increase of $120 million. Overall, while the company's debt level has increased significantly, its interest expenses have actually decreased due to various factors, such as reduced federal funds rate and lower borrowing costs. The company's financial performance varied across different segments in the recent period. On a positive note, the community, consumer, and business segment stood out with a net income of $352,286. This was also mirrored in the corporate and commercial specialty segment, which recorded a net income of $272,727. These two segments demonstrated strong profitability. However, there were some underperforming areas as well. The risk management and shared services segment struggled, resulting in a significant net loss of -$442,057. This indicates that the company needs to reassess its risk management strategies and shared services operations to improve overall performance. Management is optimistic about the company's outlook, driven by its strategic initiatives. The company is repositioning its balance sheet by investing in higher-yielding assets, which is expected to boost interest income. Lending growth in commercial and business sectors is also a key focus area, with management anticipating significant revenue generation from this segment. The company's capital markets revenue is expected to continue growing, driven by increasing demand for syndications, interest rate swaps, and foreign currency businesses. Management has also emphasized the importance of risk management, with regular updates from the board of directors and oversight of cybersecurity risks. While the company faces competition from other financial institutions, management remains confident in its ability to navigate these challenges. Regulatory requirements are also a key consideration, but management believes that the company is well-positioned to meet these obligations. Overall, the company's strategy appears to be centered on driving growth through lending and capital markets revenue, while maintaining a strong risk management framework. The company has made several significant moves in terms of acquisitions and divestitures. In the realm of acquisitions, the most notable is the proposed acquisition of American National Corporation. Additionally, there is a possibility of future mergers or acquisitions involving cash, debt, or equity securities. However, these transactions may be delayed or prohibited due to regulatory issues. The company has also made efforts to reposition its balance sheet through various divestitures. This includes selling off lower-yielding investment securities and residential mortgages. Furthermore, the company has prepaid $600 million of long-term FHLB advances, which could be considered as a form of divestiture or debt repayment. The termination of a fair value hedge during 2019 is also another example of a divestiture. It's worth noting that some pages mention potential acquisitions or possible divestitures, but these are not explicitly confirmed as actual transactions. Nonetheless, the company has made significant strides in repositioning its balance sheet through various acquisitions and divestitures. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to its shareholders. According to the provided information, the company has indeed paid dividends, as mentioned on pages 115 and 151. In addition to paying dividends, the company has also engaged in share buybacks. This strategy allows the company to reduce its outstanding shares and potentially boost shareholder value. The company's decision to buy back shares is evident from references on pages 42, 115, and 151 of their annual reports. That concludes the financial summary for Associated Banc-Corp. Feel free to comment below, and I will be happy to answer them when possible.